In late 2023, Canada and India experienced an acute political rupture. The fallout included reciprocal visa suspensions and the expulsion of high-level diplomats. Conventional geopolitical theory predicts that a breakdown of this magnitude will trigger a collapse in bilateral trade and a sharp withdrawal of foreign investment. Plotting diplomacy against actual merchandise trade reveals a stark contrast. While the political line plummets, trade volumes remain steady at $8.5 billion. Institutional capital is even more striking. Canadian pension exposure reached $100 billion, growing completely undisturbed. By mid-2026, both governments are now moving to accelerate trade negotiations, targeting a total bilateral volume of $50 billion by 2030. This suggests institutional capital and physical supply chains operate on a logic that is effectively insulated from federal diplomatic noise. The question is, how a bilateral relationship emerging from such a deep freeze can realistically expect to triple its trade volume in 4 years? Federal diplomacy sparked re-engagement, but the corridor's underlying resilience is rooted elsewhere. The Canada-India relationship functions as an aggregation of decoupled, highly independent provincial supply chains. Under Canada's decentralized system, provinces hold direct authority over natural resources, education systems, and investment promotion. These provincial economies prioritize long-term macroeconomic fundamentals and corporate demand over the daily shifts in national politics. This subnational buffer is the true anchor of the trade corridor, allowing commerce to continue even when political friction is high. To evaluate the $50 billion target, we have to look past the political announcements and focus on the raw numbers. This calculation shows the compounded annual growth rate required to reach the 2030 target from the $17 billion baseline. It requires 30.9% annual growth. Isolating merchandise trade, scaling from $8.5 billion requires a mathematically daunting 55.7% growth. Historically, this economic relationship has expanded at an organic rate of roughly 8% annually. Organic corporate growth alone is incapable of closing a delta this large in only 4 years. Reaching the $50 billion mandate requires a structural intervention to dismantle existing trade barriers. A breakdown of the $17 billion trade baseline reveals that Canada's trade surplus with India is tied to a very narrow set of flows. Most of the recent growth in bilateral trade has been driven by the services sector, specifically education-related travel. This reliance on international student tuition leaves the trade surplus exposed to domestic policy changes, such as study permit reductions and immigration caps. Meanwhile, Canada's merchandise exports are currently concentrated in a small number of resource categories. A major constraint is tariff asymmetry. Canadian physical goods currently face significant duties at the Indian border, including taxes up to 125% on automobiles. Expanding high-value merchandise trade is the primary economic objective for the relationship through 2030. Canada's map reveals how provinces bridge this gap. As India's industrialization drives global energy demand, British Columbia and Alberta are exporting heavy crude and LNG from Pacific terminals. Further inland, Saskatchewan is emerging as a critical clean energy supplier. A $2.6 billion contract will supply Saskatchewan uranium to India's Department of Atomic Energy, supporting a nuclear grid targeting 100 gigawatts. This energy access underwrites India's industrialization, creating a structural link that is too essential to be abandoned during political disputes. Beyond energy, India's demographic trends are driving a second major requirement: food security. India's domestic protein deficit is continuous and immense, creating a permanent need for reliable imports. The vast Canadian prairies have established themselves as a primary solution, producing immense quantities of high-quality agricultural commodities. This results in a flow of peas and lentils worth up to $1 billion annually, moving from Canada directly into the Indian food supply. This trade loop acts as a vital stabilizer for Indian domestic food prices, ensuring baseline food security for a growing population. These agricultural links are a baseline necessity, operating independently of the diplomatic climate in either capital. In Eastern Canada, the relationship is defined by institutional capital, operating on timelines longer than election cycles. The province of Quebec serves as a major source for long-term investment, deploying over $10 billion into Indian infrastructure. Simultaneously, Ontario has become the primary North American entry point for India's tech sectors. Ontario hosts significant greenfield investments from Indian IT giants like TCS and Infosys, while also collaborating on supply chains for the electric vehicle industry. While the western provinces provide the physical resources, the eastern provinces provide the financial and technological infrastructure for the relationship. While these subnational supply chains are robust, they are currently limited by high duties and unpredictable regulatory changes. The 2026 Comprehensive Economic Partnership Agreement, or CEPA, is being negotiated as a structural solution to these barriers. CEPA is designed to establish enforceable, science-based regulations to replace the sudden tariff hikes that have previously disrupted agricultural trade. In integrated sectors like aerospace, the agreement focuses on preserving duty-free cross-border movement for high-value components. It also includes regulatory guarantees to protect the multi-billion-dollar pension investments that anchor the relationship. This agreement functions as a transactional legal framework designed specifically to institutionalize and protect the existing flow of subnational commerce. The Canada-India trade relationship proved resilient because its provincial roots were too deep to be severed by federal politics. This case study reflects a broader reality in an era of global trade volatility and shifting geopolitical alliances. Structural economic complementarities possess a significant degree of autonomy from the unpredictable nature of national diplomacy. Reaching the target of $50 billion is a feasible goal precisely because the decentralized provincial architecture is providing the momentum. In an increasingly fractured world, the most resilient trade corridors are those built upon subnational supply chains that have become too integrated to fail.